Welcome to this evening's webinar, How Will the Federal Budget Affect Canadian Dentists? The Good, the Bad, the Ugly about the Budget. It is being presented by Adam Teneschuk. And with that, I get to introduce our very own Veronica Brown, Strategic Account Manager for all of Canada, and Joanne Friedman, our Clients Experience Manager for all of Canada. Ladies, take it away.
Great. Thank you so much, Jessica. And thank you everyone for joining this evening. It is my privilege to introduce you to Adam Teneschuk. Adam is one of the co-founders of Dental Tax. He has been working in tax and financial planning industry for 15 years. Adam holds an MBA from the Richard Ivey School of Business and holds a Chartered Investment Manager designation. His main objective is to help his clients save on taxes, time, and help them grow their net worth faster. Adam assists with this process by implementing wealth building strategies. Adam, please go ahead.
Thank you very much, Veronica. And I wanted to thank again DSG for allowing me to participate and speak to the group today. Today, we're going to talk about how the federal budget that was just released last week on the 19th is going to affect Canadian dentists, and talk about the positives, the negatives, and the real bad things coming our way. So what we're going to cover today in the lecture here is that, one, how is the federal budget going to impact the office, right? That's one of the things. Are there any benefits that are in the budget that can help us reduce taxes? That's what we're always looking for. And how does the budget affect us moving forward? Are there any kind of snippets or things that may affect us in the future? What strategies, now that the budget is out, what kind of valid strategies can the incorporated dentist take advantage of and still take advantage of? And then steps to help our dentists that need to take these steps. How do we get and implement this? So let's start with the bad news. So first off, the government came out with something called the housing and luxury tax. So this may not be concern to many, but what it is essentially starting in 2022, there's going to be a 1% tax on certain real estate owned by non-residents, non-Canadians that are renting, but there's no one using the premise. Now, I don't really know how they track this, but at the end of the day, they're just trying to get revenue from something that won't really impact the average working Canadian and entrepreneur in Canada. So I think this is more of a little bit of a cash grab. The big one, and it will affect some dentists. I was talking to the team here just before we got on the call, and I did have a dentist that's looking to acquire a Tesla, and we'll go through that in a second. But if we buy any car, boat or plane, I don't think the planes are in a category, but it's going to be 10% more again in 2022. So big picture here, let's say we're looking for, I just use that just because everybody is all about the EV side, Tesla, e-tron, whatever that's coming out. But if the car cost $100,000 or over $100,000, next year it's going to be automatically $110,000. So the government is going to take that $10,000, plus they're going to tax the HST or GST on top of that, and they're going to get the full taxation of that. So basically, we're paying 10% more plus the 13% on top of that for the government. But if we can afford the car at this type of pricing, articles in the Globe and Mail and so on, just they don't basically think it will affect the buyer too much to not buy a car. So we might see some volume this year in regards to larger car purchases, and my guess is more on the EV side than not. Second, this would have been the only big negative that I really saw in the budget, and audit enforcement measures are going to be jacked up, and we would assume that this is a true fact because we have all these programs coming in. We had CERB, we have CRB, we have FQs, we have the rental relief programs. There's so many, and the CEBA loans that many of the dentists that we have in terms of clients, basically all dentists should have taken advantage of the $40,000 plus $20,000 loan. But we have to figure out how we're paying for this stuff. And the government is going to be spending $300 million on their audit team. So what does this mean? Well, really, normal Canadians that are just filing, which is the general population, it's not going to affect them much. So they're coming after business owners, right? So this $300 million is coming after the doctors, the dentists, anybody with a business. And they're looking for tax avoidance strategies that have been implemented from various accountants or friend of friends and so on over the years. So one of the big things that they're going to be looking for, and we always tell our dentists, the only way to get money out of your corporation is a dividend or a salary. So if I needed to take out $100,000 for that wonderful Tesla, I have to take that out as a salary or dividend. Obviously, I'm going to have to take out more because I have to pay some taxes. A lot of clients, not clients, but a lot of dentists, what they've done that we've seen is that they'll take that $100,000 and then on their balance sheet, which is your financial statement package that your accountant gives at the end of the year, says that you owe the business $100,000, using that kind of example. That is not really allowed because, again, the only two ways to get money out of the business is dividend or salary, not a loan, right? We can't, if you're a shareholder of the company, you can't loan yourself money in that year and then put it back. Now, there are certain strategies where you can take it out in January and you put it back in December, and they never saw it, right? Because a balance sheet is a snapshot in time. So that being said, if you took money out in January 1st and you put it back December 31st or December, anytime in December, and it shows up, that again would be a wash. But people that we've seen have been carrying those balances over. We actually inherited a client of ours that has been doing this for 3 years. So she has a positive shareholder balance, meaning she's lent the money to herself, has not issued a dividend or paid a salary, but she hasn't been caught yet. And this is one of the larger tax avoidance strategies that we see many prospects that we talk to trying to take advantage. So again, the only way to get money out of a company is either a dividend or a salary to your personal hands, So one of the big things that is a negative coming, and they're going to be coming hard because they need money, right? So, and you know what? That's it. That is the bad. That was the only bad out of this budget that we found, is this measly luxury tax and beefing up their CRA audit team. Now, they're probably doing that for next year when they come and get us. They're going to come and get us hard probably, but that's it right now. So happy faces for the Liberal government. There's no election, and these are probably the reasons why, because there was rumblings that there was going to be some sort of election coming, and they needed to figure out ways to not have the parties force this election. So now about the good, right? The good news is this was a big one, and this is probably going to be an issue moving forward. And we're always going to be looking at this as like accountants, is the capital gains taxes. So typically in Canada, most people with capital gains mainly are wealthy people. So what is the capital gain? So basically the capital gains rate right now is 50%. So if you bought a stock at 100, if you bought $100,000 of a stock in an open account, so either in your corporation or in a non-tax, like a taxable account, so a joint account between you and your spouse, or your own personal account, not a TFSA, not an RSP, not an IPP or an individual pension plan. Basically 50% of that gain is going to be taxable. So 100,000, we got the stock, or the company goes up to 200,000, we sell. Well, we have $100,000 gain, right? So now we have to pay tax on 50% of that $100,000 gain. So inside the corporation, 25% of that is is going to be taxed or is taxed at 25%. And then same as a non-incorporated individual. It works out to be about 25% is the net kind of tax on that. So big picture, this was something they were thinking of changing. They were thinking of bumping this up to making 75% taxable, not 50. So, which is very powerful, again, for more wealthy individuals. Because first, a lot of Canadians, what they do first is that they're going to invest in their RSP. And then second, when they don't have their RSP, if that's all full, or their pension plan that they have with their employer is full, then they're going to fill up their TFSA. So in order to fill up their TFSA, there's about $76,000 there. And if they're married, they have another $76,000. So not a lot of Canadians have the ability to flow over into an open account or a corporate account. So again, the government knows this, and they were looking to target business owners, but owners so many times, and they let go of this time. So very happy to see that. Now, one big thing for dentists that are incorporated and have investments inside their corporation, there's an account called the capital dividend account, and you might have heard of it before. But what is the CDA account? It's not the Canadian Dental Association. So what the CDA is, it's a notionary account. So it's a make-believe account, but CRA tracks this account. So when you sell inside a corporation, a passive asset, so using that $100,000 again, so we take that $100,000, a capital gain on that $100,000 is going to be 50 grand, right? So again, stock went from 100, you sold at 200, our capital gain was 100, so we got 100,000 of profit that we made from the sale of Shopify, right? So Shopify made us 100 grand, great, love it. So out of that 100 grand, $50,000 of that 100 grand can actually come out of the corporation tax-free. Very powerful. Now, the government's not taking this one away, but I don't think a lot of dentists know, or a lot of accountants kind of tell their clients that if you made a gain in the corporation, and let's assume, again, when we do our plans with our dentists, we want to know their personal situation, we want to know their corporate situation. Now, personal situation, let's assume they bought a pool or they have some debt. Let's take that money out and let's pay down some of the debt. Now, the other 50,000, as you know, stayed at 50%, which is great, but 50% is now going to be taxed at 25%. That's the capital gain tax rate. So basically now we can take $50,000 out of the company for free. The other 50,000, let it stay in there, right? Because if we take the other 50 out, then there's a dividend or taxes as a salary, right? So, but we can take that $50,000 out for free. So again, very powerful. I don't think a lot of dentists realize when they have a holding company or an associate DPC or even a normal DPC that they can take that money out. And again, capital dividends, these can be used for anything, right? So you take it out, it's in your personal account. So the cash went in your personal account. But again, for our clients, depending on their situation, and it's very important to look at their big picture, go through a plan, and spend time on tax planning, because that's the very key to any of this stuff is tax planning. Because what we do see is a lot of accountants out there, they're great, they'll respond to questions, but they're just not proactive, right? So they're just not looking at your big picture. They didn't do a plan. So they're just taking your bookkeeping, or if they're doing their bookkeeping on their own, and then they tell you at the end of the year, hey doc, this is your personal return, this is what you owe, either refund or not, and then here's your corporate return, this is what you owe. So we want to make sure that when we take out these capital dividends, again, it's all tracked at CRA. So if you don't even know, you can ask your accountant, what is my capital dividend account? He can look it up. So every buy and sell, if there is a gain, it creates this account, this fictitious account, and then it's tracked, and then at any given time you can hit enter and you can take that money out. Again, half of that money out is tax-free on the gain on the sale. So if your accountant says you have a $100,000 capital dividend account, you can take $100,000 out for free. Right? It's still deemed as a dividend for tax purposes, but it's a tax-free dividend into your hands. So, and then we want our clients to pay down the mortgage, right? So we don't, the other big caveat too is that a lot of dentists like to save inside their own dental professional corporation. But whenever we're talking to our clients, we either want to make sure they have, if they have one practice and the debt is paid off and there's a lot of cash flow in that one office, set up another dentist and you actually become an associate to that office. And all the money is now being moved from your operating office to the associate office. And that's where you would be investing. Or if you have a real estate company, if you own the building, you have investments inside of that company, or a purification company. A lot of accountants like to say. And the reason why is that if you're going to sell your practice, you need to purify your practice 2 years prior to sale. And it can't have more than 50% of the market value of the passive assets, so the stocks and bonds and mutual funds in there. Can't be more than 50% of the market value, or you lose your capital gains exemption. So example here, we have Dr. Smith. This is just normal DPC. He's got $1 million in investments. Now, the other issue here too is if we're going to sell this company and we're going to do a share sale, well, again, the only way to get the money out for doing a share sale is a dividend or salary, right? Or we do something called a purification. We can move the money out to another company. You're not a dentist for a day, you just move the money out, but you have to now wait 2 years. So maybe that wasn't your intention. 1, 2, 3 comes along, Dental Core comes along, or your associate comes along and you wants to buy your practice at a great price, good opportunity to sell. But unfortunately, you had $1 million of investments in there, and we got to get it out, right? So big caveat though, the market, again, if it's an ADOT practice with $3 million in revenue or value, then you would be okay. You're on side. You still have to get the money out, so there's a mechanic to get it out. But the viewpoint here is we want to have DPC, no investments. Let's set up another corporation where we move the money over. You're an associate. So just like you pay your associates, or if you are an associate, you're depositing your money into this company all the time. That's how you'd be doing it in this situation. So dentist owns OpCo, which is Dr. Smith DPC. Got to pay for myself. I got to pay for my gross billings, okay? Or I send that money to Dr. S. Smith, which is the associate DPC, and that's where I'm going to keep my investments. That's where I'm going to keep my real estate. That's where I'm going to pay myself a salary. And the reason being is when I go to sell my Dr. Smith DPC, there's going to be no investments in it. So it's going to be free and clear, and my money is going to be in Dr. S. Smith Associate Corporation. So that's one of the main strategies that we've been using for our dentists is, one, capital gains and change. Great, because that was on the docket. They wanted to bump it up to 75% being taxable when you sell a stock, not 50. So that's staying the same. And the power of the capital dividend account. Again, notionary account. You could take this money out tax-free, and you just have to ask your accountant what it is. And again, obviously you have to have investments and you have to sell, and there has to be gains. So those are the things that you have to use with a capital dividend account. Now, the other good, there were no changes to the personal or corporate tax rates, as well as GST. So again, how are we going to pay for this stuff? I really think this $300 million to the audit side is how we're going to pay for this stuff. So they're going to be going after the dentist and anybody, not just dentists, but a lot of people that we see. And I had another just sidetrack, but I had an endodontic client of mine, and essentially, big picture was they went up to a cottage, they rented the cottage. The cottage was $6,000 for the week. And he's an associate. So when we did the taxes, I said, what's the $6,000 for this rental? Oh, well, I was associating at the same time. And, I was going back and forth with the kids from the beach to the office. So again, these are the things that this audit committee is going to be using. You cannot write off a trip for the family, run it through the corporation. Again, CRA is the honor system, right? So can you do it? Yes. Will you get caught? Maybe, maybe not, right? So these are the things the risks you're willing to take. But big picture, tax rates don't change. You can see, I really hate being, the only part about being a Canadian that I hate is anybody over 50 over $220,000 of income. And to be fair, I don't really feel that that's a large, like a huge amount. The US is 500,000, but they tax us, our marginal tax rate is 53.53% on income. So that's the only beef about this country, but the good news is they didn't hit us with another hike, and they definitely could have here in Ontario and federally. So, but just looking at this table, again, this is the personal table here for Ontario. Capital gains, you can see the tax rate as we go up. And in the previous slide, I said the tax rate for capital gains is about 25%. So if you, in the corporation, you sold that stock, $50,000. Now $50,000 is going to be taxed roughly about 25%. Same idea as here. If you're earning over 150,000, typically you're paying about on average 25% on that sale of that stock, right? So again, the ones you want are capital gains, very powerful. Non-eligible dividends, as you can see in that table, those are dividends when you issue yourself a T5 slip from your accountant. So good news on that side. So again, good news. We did a presentation with DSG and Sandy Bergeron back in January, at the end of January, and this is called the capital gains exemption. So capital gains exemption, they left it alone. This was another thing that they were going to take away from business owners, and again, they kept it and they left it alone, and they weren't going to remove it for the owner of the business, right? What they were going to remove it for was for family members 18 and over that are gross shareholders and weren't involved in the business. So they were going to say, hey, you know, if your son, your daughter, your spouse, your mom, your dad, because these people are family members, they can be a gross shareholder. And again, people forget, and I'm going to go over on another slide. They'll say, yeah, my spouse is a shareholder, or my child 18 or over is a shareholder, but they are the wrong shareholder. They are a preferred shareholder or a special shareholder. A preferred shareholder or a special shareholder does not participate in the growth of the dental practice. Pre-2018, you were able to give your kids dividends and it would pay for school, and they pay $1,000 or $2,000 in taxes personally, right? Great way to fund their university. Government took that away for all doctors, dentists, and service-based businesses, said basically trying to jab doctors, dentists, and everybody else in the service space, like accountants, lawyers, and so on, got even cleaning people and et cetera, got pulled down with that. But every Canadian's entitled to $892,000 of free capital gain when they sell their practice. So if I can multiply this, we can then double, triple, or quadruple this depending on how many family members we have when we sell the practice. Now, we can't just add somebody. We had, like in a presentation before, I'm not going to go into detail, but we have to freeze the value of the company. Then future growth can be for your mom, your dad, or your children, or your spouse. But if we haven't added them on as a gross shareholder, unfortunately, there's some more accounting work that has to be done. So as a dentist, you worked hard. You don't want to pay taxes. And the capital gains exemption is owning a practice is one of the best fundamental ways to get tax-free dollars in your pocket. And again, this has to be done when you're setting up your corporation, or unfortunately, you're going to have to fix it later. And here, great example, just have a brand new client of mine, a dentist, came on board. His accountant, his brother, the accountant's brother is a dentist. And he said, you can't do this. You can't add your spouse as a gross shareholder. The guy's an accountant and his brother is a dentist, and he didn't even know you can add spouses, family members, again, 18 or over, on his gross shareholders. And I scratched my head. He's been a client for this guy for 10 years. And I said, Doc, he just ripped you off for $892,000, because practice values have increased tremendously when you listen to Roy and all the other practice appraisal companies out there. And who's going to pay that for you? Like, who's going to give that money back? And again, all about tax planning, knowing about your situation, what your family members want. And this has to be done right at the beginning. Now, it doesn't mean if it isn't done, we can fix it, right? But unfortunately, to fix it, it's going to cost money. So main purpose here, and this was a slide actually from the last presentation, but Common shareholders are gross shareholders. They participate with the gross of the practice. The dentist is going to be the voting common shareholder, but the non-voting shareholder can be your spouse, can be your kids, can be your mom and dad, right? So a lot of the time we see the preferred shares or special shares when the lawyers and accountants do. So the articles of incorporation, so when you get incorporated, that piece of paper that you sign, it's probably about 30 pages, says that, and then we'll tell you who the shareholders are, right? But preferred shareholders do not participate in the growth of practice. Majority of dentists, again, have their spouse on or kids on or mom and dad on as preferred shareholders. And that was back in the day, good way to strategize and to get money out of the company, pay them a dividend, get it out. But we can't do that now because of Trudeau. So he cooked us back in 18. So luckily he didn't want to take these strategies away, but big reason why. And again, here's just a classic example. I have a practice. I'm selling this practice for $2.6 million. I get $236,000 multiplied by 3, free. There is no tax to be paid, right? So I have my dentist is Dr. Smith, obviously, wife is Kelly, and mom is Barb, right? So now I get to do 892 times 892 times 892, tax-free, tax-free, tax-free. Very important. Now, if we didn't have that, Doc would have to pay basically 236,000 times 2. So I don't know about you, but I'd rather have over $460,000 in my pocket when I retire versus just having 236 that are having no taxes that I would have to pay at all. So very powerful tool. They didn't take it away. It was on the docket to take it away. And I know there was a letter from our competitor firm DCY that came out to their clients to act now, to freeze, to get your family members on now. Well, actually, this is, sorry, it was not cancel that. It was to realize the gains. So it was the other way around. So lock their profit in. So if they did take it away from us, they can't do anything about it. So good thing was that they were wrong, and the government is going to let us have that. So now going on to the actual budget, there were some things in there that are beneficial to our practice owners. This one, not so much, but just letting you know if you have family members or people. But a lot of the benefits were extended. We had the Canadian Recovery Benefit, replaced the CERB, of course. We have the Canadian Care Benefit, which is helping elderly people, helping family members that need help, if any family people are doing it. Canadian Recovery Sick Benefit. So this one is if you have a family member or you've been in quarantine due to somebody for those 2-week duration, you are actually entitled to $500 for those 2 weeks. Now they're extending that to 4 weeks. So another benefit where you get $500 a week until you get better, right? So it doesn't mean you can collect each one. It's until you start to work again. So you have to self-isolate typically for 2 weeks. The government's going to give you $1,000, right? So my father-in-law, as an example, had COVID-19 at Christmas time. We had to self-isolate, and in theory, I'm entitled to the sick benefit. Now, I didn't take it because you never, you know, I'm always scared of the government opening up the coffer to other things, of course, but you are entitled to it. And again, if you're an owner of a practice, all you're getting is a dividend salary. Take that sick benefit. Very easy, right? Budget extended these programs again for 4 weeks from 2 weeks for the Canadian sickness benefit, and then the other programs did get extended as well. So another reason why the government is going to come after business owners and taxpayers to pay for this stuff because somebody's going to have to do it. Good one for, I don't know if you have kids or even if some of you have OSAP loans or what have you. The good news is grants have been increased, and as well, the other good news is if you have an OSAP loan, you don't have to pay interest on that OSAP loan until March 31st, 2023. So again, more so for kids, dentists graduating with, so we have an associate ours just graduated. He doesn't have to pay his OSAP loan down if he so chooses not to, and the government's not going to charge him interest. COVID extensions for the corporation. They've extended the queues, which many dentists are aware of, to September 25th. Again, it's a declining scale, so you have to have declining revenue to collect on this. There's a picture here. There's a link direct to Canada's website to see if you qualify. Most dentists that we see, because if you look at the situation now, offices were basically shut down. So none of our dentists, now we're all open, none of our dentists really qualify for the CEWS program anymore, but some may. And again, we'd have to go through that, but it's a declining scale. Essentially, you're entitled to $847 per your employee per week, but then it starts to go down all the way down to $452 until it gets to nothing into September, right? There's a new program called the Canadian Recovery Hiring Program, similar calculation to the CEWS. So again, we have to have some declining revenue in order to be entitled to this. Basically, from June 1st to November, the government's going to be paying up to $1,129, or 50% of the original pay. And again, declining scale in terms of what dollars they will pay out. This is for new hires and people that have laid off. So if you're hiring someone that you had to lay off due to COVID-19 and you're bringing them back, you can qualify for this program. It includes family. So, you know, if you're bringing your wife back or your kids back, and it's also new hires. So if we want to bring them back, the government can pay at least for a month of that. But again, you have to prove it's not just, hey, we're going to hire somebody. We actually have to prove that we have declining revenue in the dental office. And unfortunately now, if we look at our last time, we were shut down, now we're open. So most of us do have revenue. So it would be a tough program to do, but if we qualify, we look at the revenue and we apply for it. This is a huge one, depreciation for corporations. So if you guys were thinking about buying equipment, computers, furniture, we can write off basically 1.5 million, and as small business owners, writing off 1.5 million is probably not what we're thinking of doing, but we get to write off 100% of that in the first year. So basically, if you think about it, like a computer or furniture, they all had different depreciation rates. So it could be 2 years, it could be 3 years. So if you bought the furniture for $10,000 in year one, then so on your corporate financial statements, we could have written off, you know, $2,000, and then it just slowly declines every year. So what the government has said, hey, we want our Canadian business owners to invest in their business. So what we're going to do, they can go buy their stuff for their office, they can go buy the furniture for their office, and you can take the deduction in year one, right? And what is eligible? Business equipment, vehicles, again, not over 30,000. Dental equipment is the big one. Fixtures, leasehold improvements, you know, we're looking to fix the office up. We can now write all that off, right? So if we're thinking about patients not feeling safe and we have to put those plexiglass units up, or we do it even right, you know, it's going to cost us a little bit more, but we put glass up or whatever, make the office look pretty. We can deduct 100% of that now in year one. So very, very important. If you were thinking of buying something for the office, you can now do it. Computers, laptops, TV screens. I joked around with one dentist, hey, you need a home entertainment system for your office. So, but we can now do that. So another very big perk for business owners in general, but for dentists that are looking to buy equipment. So this kind of trumps that lease versus own too. So if we can use our line of credit, and instead of leasing the equipment, we want to go buy our equipment, slam dunk now this year on buying the equipment. So I wouldn't even second guess it. I know leasing people don't want to hear it, but if you run the numbers now, dentists can borrow at 2.2%, most of us. And if not, I would talk to your bank. This is how we do help clients. We see some clients that are prime. We'll go to their bank and try to get them down to 2.2%. So all dentists operating line of credit, term loans should all be at 2.2%. And if they're not, give us a shout. We can help you out too there. Or just go to your banker and say, hey, put me down to 2.2. Strategies that are still working. It was in the ODA journal, but it's critical illness. So COVID-19, people are getting sick. I think this is a great time for dentists to have something called critical illness. Many dentists do, but have critical illness owned by your corporation, right? So basically, it's a permanent insurance policy that's critical illness, so it's not life insurance. So if you get cancer, if you get a heart attack, aneurysm, stroke, all that stuff like that, you have it inside. So your corporation is going to be owner, corporation is going to be the beneficiary, and this can be something your operating company can have. Remember, we talked about the associate or holdco. We can have the operating company because there's no real value to these types of policies, right? So what you do need, though, is very crucial, is something called return of premium, right? So what the return of premium is, it's going to give you 100% of your money back. So oh, I hate insurance, I don't want insurance. This is a great force savings program. Your corporation is going to pay for it, and you're going to get all your money back. But guess what? You're going to get the money back, not the corporation. So that's one of the things. Now, the insurance company is going to issue, Dr. Smith personally, the check for all these premiums. So we're going to have the corporation pay for 15 years for these premiums, and then the dentist is going to get a personal check for the amount of money. Why? Corporation, very powerful. 12.2% is your corporate tax rate. So you have 88 cents to pay for $1 of insurance. So very powerful versus personally at a 53 marginal rate, we only have 57 cents on the dollar to pay for that policy. So if we become ill, the money is deposited into the corporation. That is tax-free, right? So the critical illness insurance is going to go into the company. You get breast cancer, stroke, heart attack, aneurysm, whatever it is, will go into the company tax-free. And you can use that money to run the office still, right? Or you can use that money to get better. Now, if you have to use it to get better, unfortunately, it's a dividend or salary to get it out. So it goes in the company for free, but in order to get it yourself, it's still a dividend or salary to get that out. But if you don't become ill, 100% of those proceeds are going to be returned to you. So again, great for savings plan. A lot of our clients like to spend money. It's a great way to tuck money away. And then in 15 years, they say, hey, Manulife, Desjardins, whatever it is, here's a check for you. Now, unfortunately, there's a component of that return of premium feature. The insurance company will calculate how much that is, that you would tell the accounting firm, and they would document that as a taxable benefit. So basically, it's almost tax-free coming back, but the rate of return on these is roughly between 12 to 19%. So as an advisor, I cannot guarantee 20%, 19%, 15% return, but these are basically a guarantee on your marginal tax rate. So great tool to protect the family, to protect your office, to get money back. And it's a strategy that's still valid. It was in the ODA journal in March in the financial planning section, and I loved it. So again, there is a component that when you do the policy, your insurance agent will say, here's what you have to give to the accountant to tell the accounting firm how much is going to be a taxable benefit. So depending on what accounting firm it is, what we typically see is Desjardins a little bit better for doing split dollars because they actually have the program built for it. But just remember, a component of that is in theory supposed to be taxable. This is how the mechanics really work. The corporation is going to pay for the policy. Now, a component the individual pays for, so the 1603, and then the $1,500 is like a dividend or a personal taxable benefit for the doctor, right? But if he gets sick, $250,000 goes to the dentist for free in the company. If he doesn't, in the case this gentleman was very young, but he's going to get $45,000 basically free of any tax, and the IRR or the return on this investment was about 19%. So very good investment for the dentist to do. Protects everything, protects the family and him. So other strategies that's still valid that we appreciate, dentists that have excess money. So again, you have to, I always, it's all about tax planning and making sure these things work. But if the dentist has extra cash flow, look, whole life strategies and universal life strategies still make sense. But they make sense in a holding company, or like a few slides back, we called it the Associate Dentistry Corporation in that corporation. Why? Because we're going to have to sell our company. Eventually, the operating entity has to get sold. We don't want to sell our insurance policy, and we're going to have to get it out. So again, valid strategy. Make sure when we're looking at this strategy that it's done right. So the way that, again, the strategy would work is the dentist will make, or the company, the DPC will make premium payments or contributions to this policy for 10 to 20 years. The policy can then be collateralized, and then the dentist, this is the strategy, the dentist can take this money out tax-free. So again, we love it, but it has to make sense for the client. And now when it's time to sell your policy, if you stuck it in your operating entity, there is a problem. We just went through one of our clients that we inherited or took on board with us, and he had a couple older whole life insurance policies in his dental professional corporation, and he can't sell it as a share sale anymore because in order to get that policy out, he has to transfer it. Now he can transfer it to himself, or he can transfer it to a corporation. Now, regardless of himself or another corporation, when you change the ownership of a whole life insurance policy, there is a deemed disposition. Just like when you sell a stock, if you bought Apple stock at $10 and you sell it for $100, there's a deemed disposition when you sell that stock. So same idea with a whole life policy or a universal life policy. When you move that policy to either another company or to yourself, there's a deemed sale, and you're going to get a tax slip. In this case, this dentist had a $500,000 tax slip, which outweighs the $245,000 capital gain benefit. So he has to do an asset sale. So again, there's no easy way to transfer these things out. There's a deemed disposition if it's going to a corporation, or if it's going to your personal hands, it's actually double taxation. So very, very important that if you're thinking about a whole life or universal life strategy, they're great. We love them. But we need to make sure they're structured the right way, and you got to have cash flow. So we definitely recommend that if you're thinking of doing any of these types of strategies, if you have, again, excess liquidity and cash flow in the company, consult your accounting team. Great strategy, but sometimes some of the advisors that we've seen, they put these in place, not thinking about future cash flow situations of the dentist. Because once you buy this policy for 10 to 15 years or 20 years, you're committed to that amount. And the worst thing is that we see somebody buy it and they can't afford to pay for it, and then they cancel it, and that's a lot of money that you just lost for the policy. Other technique or strategy is still valid. They didn't take any of this away. Individual pension plan. So this is where your corporation will pay for your pension, like the teacher's pension plan, except your company will set up a pension plan. Your corporation will make the contributions on your behalf. However, what the IPP does, you're able to contribute a higher amount than you can with a normal RSP. So basically, I like to call it an RSP on steroids. So, and the corporation also gets to take this as an expense. And legislation says, hey, your pension plan has to earn 7.5%. If it doesn't, your corporation gets to top it up and take an expense with additional dollars. So 7.5% on average is not easy to do, right? But this is, again, where we put our boring money, the bonds. We don't want the company to hit at 7.5% because we want to be able to take the expense for a higher amount. So it's a great strategy. They haven't taken this away, and there is a significant difference at the end of the day from an IPP than an RSP. So we do recommend it, and it does provide the corporation a write-off. So and it's credit proof. So something happens, they can't take that away. Here's just a graph just to show you. Typically by age 65, you can have up to 50% more in an IPP than you can in an RSP. So another great strategy, another great planning tool that your advisor or your accountant, or you can talk to us, that can help you out about that. The only caveat is you have to be about 42 years old to make sense of it. If you're younger than that, an IPP does not make sense. There's a cost to set it up, and the amount you can contribute gets bigger as you get older. So Basically, the RSP contribution and IPP contribution are the same at around 40. So the older you get, the better the IPP gets. And again, this is why tax planning is very important. So as dentists, you're kind of stuck in the middle. You have to do multiple things, right? We have to look at tax planning. We have to look at debt management. We have to look, how are we going to fund our kids' education? We have to say, okay, now how do I protect myself? If I get hit by a bus, is my wife or my spouse or my kids going to be okay? Am I going to be able to pay for the debt on my mortgage? Or am I going to be able to get to that freedom number? What is that freedom number? Okay, now I got to invest. Where do I invest? How do I invest? Is it tax efficient? Another thing we always see with a lot of advisors, they just buy a lot of product. They don't focus on capital gains that we were just talking about before in an open account or corporate account. Estate planning, or our wills done? Tax planning, do I do dividend? Do I do salary? Can I pay mom? Can I pay my kids? How much can I pay them? Very important to do all these. And then at the end of it, what's left over? So what we do see is that 90% of dentists that we talk to are missing out on these strategies. And on average, we're saving our dental clients over $34,000 in taxes. So very important to do tax planning, because tax preparation, we just went through it. It's a cost. We got to do our taxes. Everyone's got to do it. It's going to cost us money. But tax planning is really where you save your money. It's planning, it's getting everything done, looking at your corporate situation, looking at your personal situation, and getting savings in your pocket, right? But the problem is, most accountants out there just don't want to do it, right? And why? It takes time. You guys are busy, accountants are busy, and no one really has time to do it. But if you take the time to properly, effectively manage, you can save thousands and thousands of dollars in tax. And you need a proactive team behind you that is going to keep bothering you until you get these things done. So challenge we mostly see is that they're just not proactive. What we want to be is, before your year end, hey doc, you got to do this, you got to do that. Did we do this? Did we do that? Why didn't we do that? Not at the end say, okay, well, unfortunately, we have to do this. You didn't do this. We missed this. Well, why didn't you tell me about that? It's again, being in your face, making sure all the strategies are being looked at and being taken care of. So even with the DPC, your team needs to know your search situation. Your accounting team and your legal team need to be asking you questions. Are you married? Are your parents resident in Canada? Do you have kids 18 or over? And again, this is all about building that tax plan and looking at your personal situation. What are your goals? Do you want to buy another practice? Do you want to have a place in Naples, Florida? Do you want to, had a client of mine today, do you want a Ferrari? Dentist wants a Ferrari. What's the efficient way to buy a Ferrari? Well, these things happen, right? And then how much money do you need to be free, right? So what's that target? Doesn't matter how big or how small you are. Everybody needs tax planning, and tax planning goes way beyond savings, right? It goes well into your retirement, and it's the best vehicle that we have today to focus on our clients to build their wealth, right? And it doesn't matter if you're big, you're small. We have people just starting and graduating. So I have a gentleman, he's graduating, he's Canadian, but he's graduating orthodontics out of the US in Las Vegas, and he's looking to buy a practice. So it doesn't matter how big or how small you are, tax planning is essential. And it's no different as a new patient comes into your practice. They sit down in your consult room, and first, I guess we go see the hygienist. There's an oral exam. Then they'd say, "Oops, we found some things," and then you have to tell them that we need an extraction, we need some endo work, we need a root canal. These are all the same types of things we have to do. And what are the consequences if you don't do that root canal in the future? What are the consequences if we don't do the extraction or get those wisdom teeth out? Great example, my wife got told 3 years ago from her dentist to take her wisdom teeth out because her jaw is a little too small. She had 4 cavities and they didn't even find them on her radiographs. And she's been going to that dentist for over a decade, and they just found them now. So very important in terms of tax planning. Who is dental tax? Who are we? I come from a family of dentists. My dad is a dentist. My uncle is a dentist. They've been board members at the ODA for years and years. Problem I always had was my dad was taking advantage from financial advisors. Not saying they're all bad, but unfortunately, some of them have their own interests aligned. The other issue we kind of see is my friend is doing this, my friend is doing that. My friend told me to do this. Everybody's situation is different. And I had a client too that, oh no, we're both the same. We have the same salary, we have the same situation, our family's the same. Every family is different. And too much advice can sometimes hurt you. And that's why we have to do a plan. And your time is limited. You're caught in the middle. Who can help me with this stuff? Just the picture before. You're caught in the middle. You have all these things on your plate. I got to grow my practice. I got to pay down debt. I got to bring new patients in. Dental Tax, we can help you, a one-stop shop of advisors. And our whole goal is to save you time, pay less tax, and help grow your wealth faster. So that's it in a nutshell, guys. Thank you very much for listening. Thank you, DSG, for having me on. And we're always here to help.
That was great, Adam. Thank you very much. We're going to just launch a couple of polls, and then we'll get to your question and answers. Please enter them in the Q&A box. That was an amazing seminar. My head is spinning.
Oh, there's too much. There's too much.
There's so much. There's so much. Okay, so the first poll are, what are the negative tax changes? Luxury tax, increase in personal taxes by 25%, or increase in corporate taxes by 25%. Go ahead and vote. Okay, that was fast. Give you another few seconds. Okay, Adam, overwhelmingly, we have the luxury tax as
That's
the
it.
answer. That's the right answer? Okay. Okay,
Now we're getting harder.
yes. The hard part is for Joanne to remember how to launch the next poll. Okay, what are still good viable tax strategies for dentists? Individual pension plan, critical illness in the corporation, whole life or universal life, disability insurance, or A, B, and C? Well, okay.
Made it more complex.
Yeah. A few more seconds. Well, we're looking like A, B, and C is going to be the answer, correct?
Look at that, 100%. Boom.
Okay. Next poll question. Jessica? Thank you. What type of shares do your family members need to hold to participate in the growth of your practice? Preferred shares, special shares, or non-voting growth shares? I think we have a little bit of a split here.
Ah, why did I always try to say it?
Okay, so what we're seeing is non-voting growth shares at 53% and preferred shares at 37%.
So the answer is C. So we need
Non-voting.
non-voting growth shares.
All right, and the last poll. Thank you. No tenary account that allows you to take out, oh, I'm sorry, what is the capital dividend account referred to as CDA?
So it's a notionary.
Notionary account that allows you to take out 50% of the investment gains tax-free, tax scheme and I don't trust it, or C, an account to have the government tax me more. Give you a couple seconds. Okay, we're looking like A is the answer.
Love it.
Right? Yes?
Correct. Yeah, that's it.
Okay, awesome. Okay.
I hope it's not a tax scheme.
And then on to the questions. So far we have two questions. First one is, you said we can now write off 100% of capital expenses. Is this for 2021 only, or is this something that is applicable moving forward?
Yeah, so it starts now, and you're right. I believe it does go on, but I believe it's either, I have to look it up, but I think it's till 2023, I believe. So we do have some time, but it does start right now, as of April 19th.
Okay, great. The next question we have for you, Adam, is are you able to help with dentists working in Quebec or let's say other provinces?
So we do help other provinces. Quebec is a little challenging. We can help with tax planning, but typically we steer away from actually doing the accounting work. But we have clients in BC, we have clients in Saskatchewan, we have clients in Alberta. It's just unfortunately Quebec's a little quirky.
So Adam, the next question is about pricing, and this may be something you may want to answer offline, but it says, how much do you charge for corporate plus holding company tax, and do you include payroll and bookkeeping in that price, and how much for personal tax?
Yeah, everybody's situation is exactly to that is different. So I recommend feel free to go to dentaltax.ca/start. We can have a free consult where we can discuss this. Now, we do offer all the services mentioned, but we don't do payroll. Payroll, we recommend typically a program called WagePoint. Very cost efficient. Payroll can be very punitive, and it's commoditized. So it's something that's very dangerous to do if something is done in error. But we do bookkeeping, we do tax planning, we do tax preparation, filing, etc. We just don't do payroll. And again, reach out to us because it's all set depending on your size of your practice. So very, very tough question to ask.
Right. The next question I have, it says, do you have a handout with the information in this seminar? Are we able to provide the slides from this presentation, Adam?
Sure, I guess, yeah. You can hand out the slides, no problem there.
Okay, I'll send out an email to everybody with a copy of the slides for them.
Next question, in a year you chose to pay out the CDA account, how much accountant charge for additional paperwork and calculations? And that may be the same answer as before.
Well, to be fair on that one, there shouldn't be much because typically, again, the accounting software that the accountant uses keeps track of this. So it shouldn't be that much more. Now, there is another piece of paper you do have to sign, and typically your accountant will prepare a document that's for your minute book. So maybe a couple $100 at best, but it shouldn't be expensive. Like, I know with some of our clients, we don't charge for it, right? Like it's just part of our package.
Okay, next question, Adam. So if I build an office and I spend $500,000 in 2021, can I expense $100,000 in 2021 and then $400,000 the remainder in 2022?
Yeah, the depreciation would have to be worked on profit. So clearly, if we don't have the profit to write off the expense, it carries over. So meaning like, again, if we did $100,000 of a renovation, but our profit for that year was only $50,000, you know, we still have $100,000 left that we're going to carry over to the next year.
The next question is, can you recommend someone for dentists working in Quebec?
Unfortunately, no, I don't know of anybody.
Do you have experience with real estate? My husband and I have a few income triplet properties. My husband is also a real estate agent with his own corporation.
Yeah, that's new. Yeah, the real estate agents just recently, I think it was in November, been able to incorporate. But yes, we do have clients of ours and spouses that are real estate agents, and we can assist in that area as well.
Well, I think that there are no more questions. Last call for questions. And if there are no more questions, Veronica, would you like to close it out?
Sure. Well, we'd like to thank you very much, Adam, for the information provided in this webinar. I think it was fantastic, and it probably gave everyone a great insight into the 2022 tax year. And thank you for Joanne and Jessica as well for all the help with these webinars behind the scenes. And with that, I wish you all a very nice evening.
Well, thank you very much, guys, for your time, and everyone still stay safe.
Thanks, Adam. Good night, everyone.
Yeah, bye-bye.